As you can see, Bitcoin is still trading above all-time high territory in the 73K range as we approach the mid-April halving. Good morning, guys. It's Keith Allen. And yesterday we talked a lot about the halving with some wildly speculative numbers that I shared with you based on some research that we had seen online. And, you know, there's a lot of this. Like I said yesterday, there's a lot of different opinions of what Bitcoin price is going to do after the halving. For those who aren't familiar with it, the halving basically means that the supply is going to be cut in half, as the word by definition suggests, right? So at the moment, miners are able to mint 900 new Bitcoin a day. And after the halving in April, that's going to be down to 450 Bitcoin a day. That matters a lot because demand for these products is through the roof. I mean, the ETF inflows have just been continuing to pump into the market and really pump Bitcoin price. A couple days ago, we had really a new record for BlackRock with nearly $1 billion in inflows. And the whole market actually had over $1 billion in inflows on Tuesday. So Wednesday, also another big day, 683 million into the ETF pots, if you will, among these 10 entities. Of course, Grayscale continues to bleed, but you know what? They're really getting outpaced by all of this attention that the other institutions are getting. So, needless to say, I don't expect this to slow down anytime soon. And in fact, I do expect that there will be a second wave of institutions coming into the ETF market as they get through with their due diligence, and that, of course, is going to bring another wave of their clients, investors coming into these products to get some Bitcoin exposure without actually owning Bitcoin. That discussion is for another time. Today, I want to talk more about the halvings, right? So what we read yesterday said that typically we see a 33% gain in the 3 months after the halving, more than 80% at the 6-month mark, and more than 500% a year after the halving. So I want to actually look at these moments in history on the chart and see how things stacked up, because it hasn't been the same every time. All right, so let's go back to the first halving back in November of 2012. And let's actually even go to, let's try and do this on time, right? So November, 3 months would be February, right? So February 28th-ish, we'll just ballpark this, right? It's not critical, right? So mid-February, come on, you can do this, Keith. All right, that's 188%. And then 6 months would be April, Mayish, right? May, let's call it. Okay, so there was a little pullback in May, right? It went higher, but then pulled back. I mean, we're just being conservative here, okay? So that's over 900%. And then, we're now, let's see, that's a year at this point. Little over a year, that was over 9,000%, okay, on the first halving. That's when price went from $12 up to a whopping $1,163, okay? Now the second halving, and notice what happened before that halving, right? Okay, just before it, price was appreciating. We had some big volatility here, and actually had a pullback just prior to that halving, right? That went down about 25%, okay, just before that halving. So there's that. Now we move into the second halving. This one was in July of 2016, and you can see some volatility led right up to that moment. We had some volatility, okay, and this volatility included, how much was this drop? 30% just before the halving. Interesting. And look what happened after it. Another 30% dump right after it. This had to freak people out. And it broke through the 200-day moving average. I'm sure some people panicked at this point. But we know, we've been talking about this for days, for weeks, actually. If you've been following the analysis, you know that we've been talking about the number of times that there have been 20, 30, 40% corrections in bull markets. And this is one of those occasions here. Again, I'm illustrating for you. So just know that this can happen. And, for me, I'm saving some dry powder for that opportunity because I want it. So let's look at this one now. Let's see. What did we say? 30 days out. What was that? 30 days from, 3 months rather, from July. June, July, August, September, October. So let's look at October here, right? So October would be close enough, right? Close enough to the pin here for mid-October. And that got us to what? That wasn't very big, right? That was just a 12% move. Okay. So now we go for October, November, December, January. January 10th. And this gets us to %70. Nice. All right. And there were corrections along the way, right? And now we went, a year out? I mean, it was even longer for this bull market to materialize, right? But let's look at just a year. April, May, June, July. Around July 10th. And we're now up to 300%. And there is correction. Look, here's a big correction right there. Boom, it happens in a bull market. So be prepared for these dumps to happen. Look at this one. This one went almost 40%. Okay? I'm telling you, you got to be prepared for this to happen. Here's another one. Another dump in the bull market, right? Moving to a new high. And that was at 40%. And that was a 40% dump. Now, this continued, right? This continued all the way until the top of that market. And that market topped out at what? A whopping 2,848% roughly, okay? That's a massive, massive move. Now we look at the third halving. This one happened in May of 2020. And if we go out 3 months from this, let's see what that brings us to, right? So May, June, July, August, 11th. Just trying to bring some validity to some of these numbers because they're crazy, right? So I honestly don't see, even though I've been hearing numbers in that ballpark, and I said yesterday that, I chose that because it had some confluence with what I had heard. I dove into it deeper. So we're just putting the charts in front of us and looking at and getting the facts, right? So here's the facts. This was a 45% move, 45% move after 3 months. And now another 3 months would be August, September, October, November. Let's go to November 11th. October, November 11th gets us up to 86%. And then where did we top out? Okay, it was 661% till this was really top of market. This is where distribution began. But let's go ahead and take it all the way to the all-time high because highs matter, right? And we're now at over 700%. So I don't know how much validity I give to the numbers that say that after 30 days on average, we're going to, after 3 months on average, we're going to see a move of 80% because there's no consistency to that. But it was 33% after 3 months, 80% after 6 months, and more than 500 a year afterwards. Here's the bottom line here, right? It's really quite simple. After these events, price is going up, okay? It's just a supply and demand issue, and we know that demand is higher than it's ever been. So be prepared for that. But again, be prepared for the big dips to come in this cycle. They will happen. Now, because we have this ETF demand, maybe they won't be as big, but maybe they will. And I would certainly be prepared for that to happen. As you can see at the moment, we have some heavy liquidity overhead. This is resistance. As we look at fire charts, we can see we've got about 35 million, another 17, 35, 40, 50, 50. Well, let's just round 50. We'll call it 50 million and another 55. That's 105. You're over 105, close to 110 million just between here and 75K. And this shows us some confluence on the candle chart, because look what's here. The lifetime channel that we're running into right now. This is the resistance that's overhead, and this is the barrier between we've called this price discovery since we cleared the all-time high, but this is really where it's going to happen. This is the stratosphere. This is outer space, if you will. So let me widen this out so you can see this chart. We have a couple of artifacts from yesterday's analysis that showed us some of these big dips that I want you to be aware of, and note that it can happen. So this is where we're at the moment. Very, very simple. We have resistance overhead. We could see a correction at any time. If it were to come from here, let's just map them out for you. Okay. So all-time high right here. We're around, what was that candle yesterday? I'm actually on a weekly candle at this point, but the high was almost 74K. I'll bring it down just a little bit for you, right? Somebody's going to call me out. So all-time high, 20% gets us to the 58 to 60 range. This was an area of prior RS flips. As you can see, we had a lot of resistance as we went towards the all-time high. We lost that level, came back in, it acted as support for a few weeks, and then price broke down through it. So we ripped through it this time with really very little friction. We do have a little history there, so that would be a natural place to pull back to. 30% would be in the ballpark of the 50K range. That's showing up technically as 51 right now, but close enough to the pin, right? The 50K range, which obviously big psychological level for a lot of traders. And then 40% would take us down, potentially, if we were to go that deep, down to that 44K level where we had so much consolidation here, right? Let me just clear this out of the way, right? We had a lot of consolidation here in this range, and that was really the top of it. Was around 44, acted as resistance. That 44, 45K range was where we really broke through to really get things rocketing upward. So just know that those are potential scenarios that could play out. Maybe it happens before the halving, maybe it happens after the halving. But fooling yourself into thinking that it isn't going to happen or that it can't happen at all is not going to serve you well. So I hope this gives you some more insight into the situation. Obviously, the big narratives at the moment for Bitcoin are the ETF demand and the halving. So keep an eye on that as we move closer and closer to that event, which is coming up here. Last date that I heard on the halving is like mid-April, around the 19th. So maybe it's going to be the 19th, maybe it's going to be the 20th, but you get the picture. Bottom line, be prepared for this to happen. Position yourself, and when I say position yourself for this to happen, you can position yourself for up only and just say, okay, I'm just going to buy now and just let it go. And that, hey, in the long run, that may be just fine. But if you are trying to maximize your exposure and get the most bang for your buck, I personally am saving some dry powder for that opportunity if and when it should present itself. I may miss out, right? I might miss it, but you know what? I'm mitigating some risk in the meantime. That's the strategy that works for me. You got to do the strategy that works for you. As always, nothing I share in these analysis should be considered trading advice in any way, shape, or form. Trading is risky. Doing your own research, manage your risk and your exposure here. Please, I can't overemphasize that enough. In terms of pullbacks, once we get to the halving, one thing I wanted to note here that I noticed on the chart yesterday, you see I have two moving averages here, the 21-week and the 200-week. The 200 is purple, the 21 is green, and really through these moments, we didn't, this was really, really early on. We didn't even have a 200-week moving average at this point. And we did see that level get tested and then came back through. In the second halving, the 21-week was respected throughout the entire cycle. And in the third halving, it was respected. And I would, again, I would say that this is where distribution began. This was really the end of the bull market. This was a breakdown. This was a manipulated distribution rally. And then things broke down from there. This is where it was all over, right? And for anybody who wasn't sure, this was a final confirmation. This one was the one that I paid attention to, that losing the 21 week was very, very important for me. There was a little hopium here, but man, that red candle, that was the end, right? That was the nail in the coffin. And that was at the 25K range. And of course we dropped another 10K from there after the FTX crash. So again, giving you some insight that I hope that you can apply to your trading strategies. Hope it helps you out. Hope you enjoy the analysis. And if you do, please, by all means, give me a like, give me a share, and share a comment. I love the comments, and I do respond to each and every one of them. One last look at fire charts. You can see we now have some new bid liquidity laddering down to that 50K range. Interesting, right? The concentration here is at the all-time high, the prior all-time high at 69K. Another test to that, which we talked about yesterday, would be healthy, right? We already got one. So if we get another one, it's a gift. And that, that 30% correction, that potential 20 to 40% correction, if and when it comes, I'm looking at that as a gift. That means I'm not overexposing myself with leverage. I'm a spot trader, and that's how I'm approaching things. Hope that helps you out. One last closer look at the daily time frame on fire charts to see what's happening. And as you can see, there's been quite a bit of selling from this range. So we are seeing some distribution happen from these levels. Every time we hit a new high, we do see a little bit of distribution happening. That should be expected, each and every step of the way, right? I imagine once we touch 75, we'll get a little flush, and then hopefully break back up into that range soon after. Have to wait and see how things shake out. Time will tell. Time for patience, time for discipline. That's all I got for the day, guys. Have a fantastic day, and as always, trade safe, my friends.